Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recovery we saw in late July up from the combined supports from the congestion form from the lopsided diamond pattern between 1300 and 1180 over October-December 2021. Incidentally, within this diamond pattern are the two 50% Fibonacci lines of the April 20 to February 2022 move at 1289 and the May 2019 to February 22 move at 1275. Anyway, this recovery, well, to put it lightly, and as a minimum, this recovery has kept the beans in the teens. However, the pullback up has been awkward, to say the least. Prices effectively failed at the February to date 50% Fibonacci line at 1532 in mid-August, dropping back down through the long moving average, currently 1532 also. Yeah, just want to check that. That is true. Down through the 1532, plus the change gap, and down through the 50% Fibonacci line, December 20 to February 22 move at 1451. Interestingly, it was only the congestion made up of the lesser Fibonacci lines at 1400, 1389 and 1378 that finally halted the fall in mid-August, turning the market back up again, though not by much if compared to the size of the original decline. Now please remember those levels, 1400, 1389 and 1378. They will turn up again. In late August, prices punched up through the 50% Fibonacci line at 1451, peaking on the 24th of August with not only an indecisive spinning top, but also being capped at the time by the declining short-medium moving average, currently at 1432. The subsequent dip in early September once again found support from the congestion between the lesser Fibonacci levels at, yes, you've guessed it, 1400, 1389 and 1378. This time the resultant rally punched up through the declining short-medium moving average into some fairly free air above, all the way until just short of the slowly ascending long moving average, currently again 1532, where the market peaked 3 weeks ago with a shooting star pattern type 1 bearish. Interestingly, the subsequent decline following this peak was initially somewhat half-hearted, with prices at first only managing to get down to the 50% Fibonacci line of the December 20 to February 22 move at 1451, where they tried once again to move higher, if also in a slovenly manner. 2 weeks ago I described this behaviour thus, and I quote, "I think I can explain this lack of decisiveness on the part of the market. You see, the long moving average, the resistance last week, is rising and would be a good corralling resistance in an otherwise bullish move. However, a new factor has entered the frame. From above, we have the declining medium moving average. That's currently at 1490, which has moved down enough to be the first line of resistance overhead. Hence the market's indecision on whether to test or not this new factor. At the moment, one can surmise that the market may become pressured between from above the medium moving average and from below by the 50% Fibonacci line and the short medium moving average. That's currently at 1432. This could lead to a possible small spurt of action soon, but right now to see what is next, well, it is not easy. I suspect we may see a sideways to slightly higher action, but even saying that, I have doubts as to whether prices can attain the heights of early August just yet." And that's the end of the quote. Well, that pretty much summed up the situation we have until a move down late on Friday the 23rd of September to punch down through both the 50% Fibonacci line at 1451 and the now sidelining short-medium moving average. This was followed on lower last week with last Friday's large key reversal down that just pushed below the support at, yes, you've guessed it, the congestion between the lesser Fibonacci lines at 1400, 1389 and 1378. However, the drop lower has not been sustained, though it has also not been discarded, which leads to an interesting situation of the market contemplating whether to punch lower down to the August 2020 to date uptrend, currently at 1353, which, to be honest, does not look that great a support, and maybe dropping down as far as the July low at 1304. If that happens, then we will be once again threatening the whole idea of beans in the teens. The alternative is a push back up, which the market does not seem too inclined to doing, and which strengthens the bearish hand of the declining medium moving average as it moves lower. Be interesting to see where we close on Friday night. I have a suspicion right now That close might be key. Chicago soybean meal. We've had here a number of patterns hitting off of each other at the same time, well, sort of. The immediate pattern is a May to date ascending expanding wedge pattern, something I pointed out many weeks ago. This has now developed, it's currently a 406.20 to 478.90, though it's not a perfect pattern. This pattern was breached topside just before the last change gap, and most importantly, it has been breached late last week and again this week on the downside, such that I'm on the verge of calling it broken. The base of the pattern was the neckline of another pattern, the huge December 2021 to June 2022 head and shoulders continuation pattern, currently at 406.20. This second earlier pattern had been the signature pattern here since last year, and it resonates even now. It has the unusual though not unique feature of a head and shoulders top over February to April, crowning the head of a bigger head and shoulders pattern. Now going back to the neckline, this shallow uptrend had also been the base of a quad and arguably a quintuple bottom, resulting in an attempt higher in late August. So going back to the big head and shoulders continuation pattern, when these occur, I immediately look to see if as part of the construction of the second shoulder we see a bullish pattern. There was no reverse head and shoulders pattern, but we instead had the formation of the larger upper trend line of the ascending expanding wedge pattern, currently at 478.90. So after all this week we've seen the market take on the neckline stroke lower trend line combination. The next key obstacle on the downside was the 50% Fibonacci line of October 21 to March 22 move at 400.50. My thoughts on tackling support were not complementary to any attempt lower, and I quote from previous commentaries, well, good luck with that. The market has tried with a total of 6 times so far since May with no result. Just keep an eye on the parameters of the ascending expanding wedge pattern, as that seems to be the key here, end of quote. Well, for the first time since June, I have a suspicion that the current move lower might be successful. We still have 2 moving averages going sideways and 2 lower. Not the most positive of bearish outcomes, but it might be enough. Beyond the 50% Fibonacci line at 400.50 or another 50% Fibonacci line lower down at 386.80. This seems a reasonable area to look at next on the downside. Additionally, might now be time to place some ideas on the downside. Thus, for an ascending expanding wedge pattern, the primary target X would be in the 367 even area, and a secondary, harder to achieve, target X1 would be in the 342 even area. These are big numbers to think about, and they are based on the move lower being a genuine one and not a false break. So, for all these caveats, those are the opportunities below. It will now be interesting to see if the market follows through with this seeming break lower. Chicago soybean oil. Mea culpa, mea maxima culpa. I'll come back to why I've quoted this Latin shortly. Back to the market. In July, the market bottomed out, halted in its decline by the congestion band, mainly dating from as far back as 2011 and 2012, between 57.64 and 59.44. Since then, until the end of September, we've had a gradual ascent. Not really obstructed by anything much, passing through the 50% Fibonacci line of the January 21 to April 22 move at 64.09, the short medium moving average currently 65.12, and the long moving average currently 68.82, if only on occasion, also briefly on that last one. Prices managed to establish themselves above all but the long moving average. At the same time, attempts to revert the market back down had been met, for the most part, with countering bullish moves. Yet this did not stop the market from trying to go lower, as can be seen by the bearish open and close long black Mariposa 2 Fridays ago. Interestingly, this was a countering move to the 4th degree. What was important about this particular action was how it was the first clear break and close below the combination of the lower time, currently 66.46, of the December 21 to June 22 bullish Andrews pitchfork, also acting as an uptrend, and the 50% Fibonacci line of the January 21 to April 22 move at 64.09. This move lower was exploited last week down as far as the 2011 high at 61 even, before a pullback up over the 50% Fibonacci line. Yet even this pullback up looks limited, and it will perhaps not surprise me to see a renewed attempt lower. I will leave the broken bullish Andrews pitchfork on the daily chart for one more week, but if that doesn't repair itself, then I will remove from my daily commentary next time, my weekly commentary next time. Now, following on from these actions, my thoughts on all this are threefold. Firstly, overhead we have what I suspect is the stonewall that stopped the rises since July and the cause of this latest move lower. They are the recent April to July 50% Fibonacci lines at 71.97 and the declining medium moving average currently 67.65. Interestingly, I still suspect the power of these two may now be diminishing, as previously they had been intertwined and working together, whilst now they are separating. And as we all know, some of these together will be greater than each individually. My second thought is more strategic, which what is if this latest move up and now down is the upswing in a larger June or even May to date bearish halfway hesitation? I have no justification for this pattern just yet, but I suspected or speculated on its existence last week and also 2 weeks ago. And with the added data of this week, well, it is worth considering, as in the longer term such a pattern could fit. Of course, it doesn't need to fit, but it could. My third thought is just that perhaps this move lower is not as aggressive as in the previous scenarios. Perhaps this move lower makes a double bottom or even a rarer W bottom. For this to happen, we'll need to see how well the congestion band, mainly dating from as far back as 2011 and 2012, between 57.64 and 59.44 holds out. This will now be reinforced by a further smaller congestion at 56.34 plus the rising April 2020 to date uptrend currently at 57.39. And also the lower time, currently 58.30 of the newly drawn, last week as in newly drawn, bullish December 2021 to June 22 bullish shift pitchfork, which is the actual shallower cousin of the steeper but now broken bullish Andrews pitchfork. It will be interesting to see how this pans out, especially with the medium moving average continuing its trek lower. Finally, the mea culpa bit. Last month, September, was a monthly key reversal down. This was something I should have noted earlier, but I was too busy looking at the neckline and it didn't draw my attention. I'm responsible for that. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.